Good afternoon, everybody. Welcome to today's event, Model ETF Portfolio Sneak Preview. It's Monday, April 11th. You got John Hopkins here. Tom Bowley going to jump in just a quick minute. If you're new to EarningsBeats, welcome to the event. Appreciate you taking the time to stop by. Of course, we want to welcome our wonderful seasoned veterans. Many of you have been with us for many years. Thanks for your support. This event, like all of our webinars, will be recorded. For some reason you're unable to stick around for the entire event, no problem. We'll make sure you get a copy of the recording. The reminder too, that tomorrow is a members only event, Options Max Pain. That is one of my favorite events of the month. This is when we look at, Tom takes a look at option activity as we get into options expiration. And of course, dawned on me just the other day that Thursday is this week's expiration because of Good Friday. So it's going to make it even more interesting. All I know, Tom, is last month when the market was, my recollection at least, that had a pretty successful call on Max Pain.
Yeah, it was probably one of the most unbelievable, Max Pain weeks that I've ever seen. When we talked about it, I think on Tuesday at the close, which was just 3 days before our options expired, the QQQs, I believe, were trading at 318, and I'd calculated Max Pain to be about 354. And so when we do that, we understand that it's in the market maker's best interest to begin moving prices toward Max Pain. So from 318 toward 354, but really never in my wildest dreams did I expect that we would actually get close to 354 within 3 trading days. But I think we closed on the Qs at about 352. It was one of the most unbelievable rallies in history. And yet all the stuff they talk about on CNBC, and that is never discussed.
Never talked about.
Never.
Yeah. Well, it makes it interesting. Again, the market's closed Friday, right?
Yeah.
So we've got options expiration Thursday. So it's going to be, and with today's action, at one point, I wasn't thinking last week maybe it would come into play, but it could most definitely make a difference at this point.
Yeah, it could. We were so stretched last time. I mean, it was like a rubber band snapping back. I mean, the S&P 500 has been, pretty flat for the last few days until today. So it went down a little bit. So we might have a little bit of room to the upside, but it's not going to be nearly the type of, the variety that we had last month. So it's something that, certainly worth considering. But I wouldn't expect the kind of craziness that we saw last month. I mean, should be much tamer this month, I would think.
I just wanted to bring it up because I know we have some people who are just checking us out today. And just so you know, if you're not a subscribing member, you can sign up for a free 30-day trial, a no-cost trial, and get access to that. There's also a couple of other member-only events coming up, including the ETF draft, which will be next week. And then, of course, the Q1 earnings, which is going to be unbelievably interesting to watch. Anyways, I want to get that in. I'm going to go ahead and turn it over to you.
All right. Appreciate it. Yeah. I mean, earnings, this is going to be really interesting because there are a lot of growth stocks that have been getting hit pretty hard. And obviously, Wall Street believes many of these companies are probably not going to come out with the best of news. And even if they do beat, you might see some companies really reining in their future guidance. And so, yeah, earnings season this year or this quarter is going to be maybe a little different than what we would normally expect for Q1 earnings season. But anyway, that's a different subject for a different webinar. All right, so for today, first of all, welcome. Appreciate everybody taking the time out of their day to stop by. For those of you that are new, welcome to EarningsBeats. I'm glad you can make it. We do have a lot of great information that we share with our members and also with our EarningsBeats Digest community. So anyone who's coming in directly from an article that I wrote at Stock Charts a little bit earlier this afternoon, We'll make sure we get you added to our EarningsBeats Digest newsletter. You can unsubscribe at any time. We never require any credit card or anything for our free newsletter. But you'll get to, you'll get a little bit more flavor as to what we do and how we look at the market and so forth from that newsletter. So for tonight, what I want to do, let's pull up the agenda and we'll go through. It's not going to be a really long session. We've done these sneak previews before for our model ETF portfolio. It's just one of the portfolios that we put together. It's the only one at this point that we do with ETFs. But I think we do have some really interesting products in terms of filling out a portfolio, an ETF portfolio. I think you'll find some of this to be pretty interesting and unique, the way that we look at this. So it's always worth going through, but I don't want to spend a whole lot of time because it is fairly similar to what we've done in the past. So tonight, what I plan to do is just go through and review our ETF Analyzer. That's our spreadsheet that we've developed. And it just helps us, whenever I talk about ETFs, I just keep telling people, make sure you know what you own or know what you own, understand what you own, because ETFs, it's something where, if we weren't in a stay-at-home kind of world, you would be at the water cooler and, someone would just say, hey, this ETF really great performer. And some people just take that information and go buy it, not have any idea about what that ETF is comprised of, whether it's, highly concentrated or whether it's well diversified. I mean, stock is a stock. You think of Apple and you think of the iPhone, the computer, the watch, blah, blah, blah. But when you're thinking about ETF, you don't know anything about it. You don't know how many companies are involved in it, what the correlation is, to the S&P 500. You just know nothing about it. So when we developed some products for ETF investing, that was what we wanted to keep in mind. We want our members to at least be informed and understand, what you own. So what I want to start off with tonight is that ETF Analyzer. I'm going to pull that up here for you in just a second. Then we're going to go into some of the current themes and considerations as we try to figure out what kind of portfolio we want to put together. We do these portfolios every 90 days. So I'm not talking about putting an ETF portfolio together for the next decade or until you retire in 30 years or 10 years or whatever. This is all about the next 90 days, very, very narrow focus. And then we just adjust and we take, and we change out any ETFs that we no longer want and put in a new batch. And then you hold those 90 days. So it's not active investing, but it's also not buying and then just sitting and letting it go for the next many, many years and running into a situation like, Cisco back in 1999 or 2000 was $73. And then 2 or 3 years later, it was $11. We don't want to get caught in anything like that. So we're always constantly trying to look at the market and then put together a portfolio, an ETF portfolio that kind of makes sense. And some might say, we had 10 ETFs in our portfolio. And I've heard some members say, or folks that have seen this before, I've had emails come in and say, well, 10 ETFs, that's not diversified enough. Well, it depends what ETFs you own. Some ETFs, one ETF can be very diversified. The Spider, you own 500 of the largest multinational companies in the world. You could just invest in one ETF and be very diversified. So it's not the number of ETFs that you own, it's what those ETFs are comprised of. And putting together the portfolio of ETFs. Do you even know, after you put together 5 or 10 ETFs, do you know what your concentration is in sectors? Do you know if these ETFs are highly concentrated or whether they're diversified? Do they have, does the top 10 holdings, does that make up 70% of the entire ETF? Or does the top 10 holdings represent 6% of the entire ETF? That's a big difference. That's something really important to know. So we're going to go through all the themes and considerations and discuss a little bit about what we went through 3 months ago and where we stand today. And then I want to give you a couple of potential ETFs. These may end up in our portfolio. By the way, our portfolio draft is next Tuesday, so it's a week from tomorrow. That's when we will actually announce the portfolio or the ETFs that'll be in our portfolio for the next 90 days. And that's when the current quarter ends. So the ones that I go over today and tell you that we own these right now, they will be owned until Tuesday, next Tuesday at the close. So anybody who follows the strategy would simply be selling the ETFs on Tuesday at the close and then replacing them with whatever ETFs we draft at next Tuesday's event. And I call it a draft. I think it's kind of a cool thing because if you think about the NFL draft or the Major League Baseball draft, you have to take turns. You get to pick, and then you have to wait for your turn to come around to pick. And by the time your turn comes around, a lot of the best talent's gone. Well, when you put together a portfolio, you have all the picks. If somebody else picks Apple, that doesn't mean you can't pick Apple. You can pick whatever individual stock or whatever ETF you want for your various portfolios. So that's kind of cool. When you think about it, you could put up a pretty good NFL team if you had all the draft picks. That's what we have when we go to put together a portfolio. So I think it's a great way of looking at, the concept of building a portfolio is that you have all the draft picks. And hey, if it goes wrong, you got no one to look at but the person in the mirror. So that's kind of a good thing, some accountability. I think with our portfolios, we like to be very transparent, very simple, very simplistic, so that folks can understand what it is we're trying to do. So anyway, we're going to go through all that, and I'll give you, like I said at the very end, a couple of strong ETFs that you might consider and the reasons why. And you might disagree with me, and that's fine. That's what makes market. You don't have to agree with everything I say. You don't have to agree with anything I say, for that matter. You can go opposite of what I say. I know a lot of folks like to do that with Jim Cramer. I'm probably one of those. So, hey, if you want to take shots at me, that's fine. I have no problem with that. So let's take a look first at this ETF Analyzer. So let me share my screen. And I think you'll find this pretty interesting if you haven't already looked at this before. So what we do is, first of all, you're going to see a list of ETFs. So this just numbered. There's no reason for the numbering other than just to keep track of how many there are. This doesn't mean this is the best one because it's numbered 1. It just means, actually, I think what these are in alphabetical order, the ticker symbol. So that's the only ordering. And you can see that last time we did this was the ETF Analyzer that we prepared back in January, right before we did the draft for January 19th. So I will have something similar to this for next week, for our April. I'm working on it now, actually, putting together this ETF Analyzer and the various ETFs that we want to have on here. What we do in coming up with these ETFs, we just go through and run a scan over at stock charts. I think with this one, I was looking for ETFs that had scooter scores above 80. So if you're familiar with the scooter scores, Stock Charts Technical Rank, SCTR, it's just ranking all of the ETFs based on certain technical. It's just a formula that goes through. It's looking at, how ETFs perform relative to one another. It's looking to see, based on how far above certain moving averages current price is. Anyway, it comes up with this whole rank. And in order to meet our requirement, these ETFs have to have at least a scooter score of 80, which means it's in the top 1/5 of all ETFs. I also look for volume to be at least 100,000 shares, just so we have a liquid ETF. Some ETFs, trade fewer shares, and because the value of the ETF is really based on the value of the stocks within the basket, within that ETF, the volume is not as much consideration for an ETF as it is for a stock, but I still want to make sure I have some, more liquidity in terms of volume. Sometimes it can have an impact on the spread between the bid and the ask. If it's a lighter volume ETF, I've noticed that. So that's just one of the things we put into our criteria. You can run scans and do it however you'd like. And then the other thing we try to do is find PPOs that are greater than 0. Now, in different markets, we could change that. If we're in a deep recession at some point and everything's going down, you might have scooter scores above 80, plenty of them, because all that's doing is looking at relative strength. Even in a horrible market, you're going to have relative leaders. So relative strength isn't hard to find. But if the market is going down and most everything's going down with it, there may not be as many PPOs greater than zero. Because I had someone ask one time, well, what happens in a bear market? You know, if you're using PPOs greater than zero and you're in a bear market, well, I would just adjust the formula. So maybe the PPOs are greater than -1 or -2, depending on where we are in the market. So you just adjust the scan parameters, if you will, or the syntax. All right. So that's essentially how I came up with this. Now, one change that I did make last quarter, I think it was last quarter, might have been the quarter before, is that I did include all of the sector ETFs, the major sector ETFs. So there are the 11 right there, XLB all the way down to XLY. So the whole idea there is that there might be a theme. Maybe there's a positive divergence building in the financials. And so I might want to include the XLF as a key component in this model ETF portfolio, even though it doesn't meet the parameter. Maybe it has a scooter of 40, so it doesn't have a scooter above 80. It ordinarily wouldn't be included. I'm going to put these in here every time. So if I want to get exposure in a certain area of the market, this will give me an opportunity to do so without relying on an individual ETF meeting all of our parameters. So these would be the exceptions, the XLB all the way down here to the XLY. But otherwise, all of the others are meeting the parameters that we put in for our scan. So there were 74 ETFs on what we call our strong ETF chart list. And all of those ETFs are shown on this ETF Analyzer spreadsheet. Now, here's what's interesting is we go in and we put in all of the sector weightings for each one of these ETFs. So for instance, this Pacer US Cash Cows 100 ETF, 3 months ago, 13.08% of it was invested in technology. 18% was in consumer discretionary, 8.6% communication services, and so forth, coming all the way across. And then we just use this as our audit just to make sure they all total 100%. So this gives us the breakdown between all the sectors. And then this we make sure is 100%. And so if we're looking at an ETF, considering it, this will help us kind of work toward how much of an allocation we want in various areas. And I'll show you the totals here in just a second, how this works. The other thing that's important on here is I've got this other tab in here, top 10 holdings, and it's going to list the 10 stocks, the top 10 stocks within that ETF. And this is just being carried forward from that other tab, showing us the concentration of the top 10 holdings. So in this case, the US Cash Cows 100 ETF, the top 10 holdings represent 21% of the entire ETF. That's pretty well diversified. If your top 10 holdings, that would mean your top 10 holdings average only about 2% each. So that's a pretty well diversified ETF. Whereas this one here, this is the Alerian MLP ETF. This is an energy ETF. And you can see not only is it highly concentrated in energy, it's only in energy. So you only want to invest if you really want to get a big chunk of energy. Not only is it in energy, but 80% of it is in the top 10 holdings within energy. You better like those 10 stocks, because if they go bad, your entire investment in the ETF is not going to be good. This is not widely diversified. It's highly concentrated in just a few names. So we provide quite a bit of information. Now, we can go back and look at this AMLP, click on this tab, and here are the top 10 stocks. Now, you could pull up the charts on these 10 if you wanted to and just say, okay, technically these 10 look good, and that represents 80% of the ETF. I'm good. I like this. I want to have this as part of my strategy. You know, and that could be your call. Someone else might look at it and say, well, I don't really want to invest in energy. You know, we're in a secular bull market. I want to stick more toward some of the more aggressive areas, or maybe I just don't want to be in energy. You know, it's too volatile, whatever. Everybody's different. And then you can see here's the cash cows, the top 10 holdings here, and the weighting for each one. There's your 21% that I said carried over to the other page, 21.22, and right here, 21.22. So all this is doing is summarizing a lot of information on this summary page. Now, once we put all of this together, and you can imagine this takes quite a bit of time, I want you to notice up here at the top, the S&P 500. So I've got the allocation of each of the sectors within the S&P 500. So when you put your portfolio together, you might have certain preconceived ideas in place as far as your allocation. You might say, well, I really don't trust technology right now. If we're talking about inflation and we're talking about a possible recession down the road, technology is probably not an area that I want to be involved in. So instead of 29%, you might be thinking something less. Back in January, these are the actual numbers we had in our portfolio when we put these together. We only wanted 14, or we only ended up with 14% in our technology in that sector. Of all of our 10 ETFs that we put in our model ETF portfolio, the total worked out to only 14.05% being invested in technology, 1/2 of what the S&P 500 is. So what do we want? For the last 3 months, based on what we were seeing 3 months ago, we were kind of banking on technology not performing as well. And it hasn't. So that was a good call on our part. Industrials, though, haven't been very strong. And we were actually looking at a pretty strong, we felt like industrials would do really well. And so, the truckers and the railroads have just really fallen apart here in the last week or two. They were actually doing pretty well until the last week or two, but that's a big part of industrials, and they started to drop. And of course, industrials as a whole have not been so that was not a great call. We were lower on both communication services and consumer discretionary than the S&P. Those turned out to be good calls. Financials, we were a little heavier than the S&P 500, 14% versus 10. And we were okay there really until the banks started falling apart. We had an actual specific part of our investment in the banking area, thinking, okay, rates are going up. Banks would probably hang in there and do well, certainly do better than maybe technology. And that also worked out really well until about a week ago. And then all of a sudden banks started falling apart. So that turned out, that a little bit bigger bet than the S&P 500 within the financial space. That didn't turn out so great. One of our best decisions, though, was putting a lot more doubling of consumer staples, because a little nervous about the markets. We wanted to be more into defensive areas. So we had a doubling of consumer staples, a doubling of real estate, and energy. We're, I don't know, what's that? Probably about 50% higher than the S&P 500. And materials, we had actually a pretty big position in XME down here at the bottom. That was a 10% direct investment in XME. And when you look across here, 84% is materials, 15% is energy. So this was a specific bet on energy and materials, and that turned out to be a pretty good call. That was by far our best performing ETF last quarter. So here's the beauty of, setting this ETF analyzer up. What we did is we took our 100% that we're going to invest in the ETFs, and we decided how we wanted to break it down. So 10% in this ETF, which is the XME. 5% we put directly into the XLP, consumer staples. 10% we put directly into the industrials. 5% directly into this iShares Core US REIT index, so real estate. And again, you come over here and you'll see it's 100% direct investment in real estate. 10% went into the S&P 500 equal weight. The reason we did the equal weight instead of the spider, which we could have done down here, is that I was worried personally about some of those large cap names. The Apples, if you remember, I wrote some articles back at the beginning of the year. I was a little nervous about Apple and Amazon and Microsoft and some of the really large cap names that are so heavily weighted in the SPY. So I wanted to at least hedge. I mean, if the market went up, I wanted to go up with it. So did a 10% position within the equal weighted S&P 500, but we just wanted to take out that weighting toward Apple and some of the others. So this was, and you can see, look at the top 10 holdings in the RSP, 2.26%. The top 10 holdings in the SPDR, 29%. See the difference? That's the 10 stocks. That's the Apples and the Microsofts and the Teslas and those huge growth companies that make up such a big part of the SPDR. I wanted to be in the stock market, you know, just to participate if it went up. If it went down, it was going to go down. The RSP was going to go down. But if the Apples and so forth got hit harder, this would have turned out to be a better relative performer. The OEF. Now, this is the iShares S&P 100. This is a lot of the large cap. So I did still take on 10% of those large cap names. And you can see the allocation was in some of the higher risk areas, technology, consumer discretionary, and communication services. That's 60% of this ETF. So we did have some exposure to it. You know, the problem is if you don't have any exposure and then Apple and Microsoft, Tesla and NVIDIA and all these companies lead the market to the upside, you know, there's no way you can outperform. You've got to have some representation. So that was part of it. There's that 10% direct investment in KBWB. I think that was the worst performer that we've had so far this quarter. High dividend ETF. This has done, you know, fairly well on a relative basis. 10% investment there. 10% in the autos. I'm a big Tesla fan. I really like Tesla. And if you look, Tesla is one of the top holdings, obviously, in this EV ETF. So it was a way to get a little bit of it more exposure toward Tesla, as well as some of the other automakers. DGRW, Wisdom Tree, U.S. Quality Dividend Growth Fund, another growth area. But the allocation was different than some of the other ETFs. So anyway, if you added up all these percentages, you'd come up to 100%. And we actually have a calculator up here that just to double check us, little audit function. But right here, this is a total of whatever all the percentages here. So if this comes up as anything other than 100%, it'll show you have an error. For instance, let me just change this to 10 instead of 20 and see how that went to 90 now. So it's telling me I've only accounted for 90%. I still have to put another 10% somewhere. And so it's telling me error. So then I put the other 20%. And also you'll notice these percentages change when I put in a new percentage here. So watch the technology go from 11 to 14% when I add that, when I go back from 10 to 20. There it goes to 14. So the whole idea here, if you come all the way over here, this is detailed results. Any of these ETFs where I put a percentage in, it takes the percentage and multiplies it times each of these weightings. And then it gives you the true weighting within your own portfolio. So by putting 20% into that ETF, 4.9% of it's going directly into technology. So if you add up all of these technology, you know, all the way down, everything that we invested, if you add the portion that's being allocated to technology within each of the ETFs, it'll come up to that 14.05%. So it's just I think it's a great way to not only know what you own, but make informed decisions about, you know, are you comfortable with technology right now? Maybe you are. Maybe you believe that right now this is a great opportunity for technology, and you might want the number to be 40% instead of 29%. Well, I mean, there are ways to achieve that. And again, if you can't find enough ETFs with scooters over 80 that provide you great entry into technology, I mean, there's one, but that's, you know, pretty concentrated, 31%, the top 10 holdings, so forth. But there are others. Here's 33%. Here's 36%. That's the NASDAQ rising dividend achievers. That might be one that you might be more interested in. But then you do have these direct semiconductor that 3 months ago were doing really well. I can promise you they're not going to be on the list coming up because semiconductors have been so weak. They're not going to be they're not going to have scooters above 80. But you can always go into this technology XLK. And there's 100% right there. So if you put 25% into this one ETF, that full 25% is going to drop right there where that 14% is. And then any other ETFs are just going to add to the 25%, small pieces here and there. So there are ways to achieve, what you want. And then depending on how much research, how much time you want to put into this, we, again, have provided a lot of research, top 10 holdings, to go in and look at every one of the ETFs that we have on that list. What does it go out to 74? Right here. There's that XME. So you can see Alcoa, Newmont Mining, Freeport McMoran. I mean, these are the stocks that make up that XME. The top 10, 46% of that ETF. And you can come in here and quickly see why an ETF's working or why it's not working. I mean, it's easy to go back now and say, okay, we either outperformed the S&P 500 because of this, this, and this, or we underperformed because of this, this, and this. And we made those decisions. So look in the mirror. I mean, that's the reason why you underperformed. As opposed to just putting together 5 ETFs that you heard at the water cooler. You have no idea what you own. And honestly, whether you outperform or underperform, you're not going to know why. Because you don't know what you own. And you might actually go down. You might think they're horrible investments because they went down. And yet you might have gone down half of what the S&P 500 went down. It may have turned out they were great investments. I mean, if the stock market goes down 10 or 20%, it isn't going to matter too much what you own. Most everything's going to go down. You might have one or two ETFs that are able to weather the storm and go higher. But for the most part, if market's going down, you're going to go down. So anyway, I think this ETF Analyzer is really cool. And what we do is we offer this for download for any of our annual members at EarningsBeats. So if you're willing to commit to us for a year, we're willing to commit any of our major research on, that's been done on Excel. We allow our members to download it. So pretty cool feature, I think, where you can go in. And the one last thing I'll mention is that if you're considering looking at an ETF that we don't have on the list here, you can scroll down to the bottom and just type them in. Type them in. You have to do a little bit of your own research to put in your percentages, by sector, your weightings. And if you want to fill out the other tab, you can do that. But you can put this in, put your weightings in here, and then drop in how much you want to put into that ETF. So you can add manual ETFs in here as well. It's just that we are only obviously going to have the ones that meet our criteria, plus the sector ETFs that I mentioned. Anyway, yeah, if you have any comments on that, by the way, if you're not a member at EarningsBeats, you can always send us comments in. I'd love to hear from you. You could just send it into support@earningsbeats.com. And we'd love to hear from you. All right. Next up, what I want to talk about. So that was the ETF Analyzer. Now let's take a look at some of the current themes, some of the things I think are going to be really important for us to focus on. And as we get into this, I mean, here's one of the ETFs. This is our strong ETF chart list, by the way, that was put together back on January 12th. And if we click on this edit list, actually there were 75. One of these must have changed since from 3 months ago. Or maybe there was some, I don't know why we would have one more than what we just showed, because I think there were 74 on the spreadsheet. Or maybe there was a last minute change. Maybe I deleted one on the spreadsheet that needs to be deleted on this list. But anyway, this strong ETF chart list should mirror our ETF Analyzer. And then you can just come in and you can look at, you can download this into your stock charts account if you're an extra or pro member. Otherwise, you can still view the charts. You just won't be able to download them because you won't have an account. Or if you're a basic member, you can't download because I think you're only allowed one default chart list. So if you try to download a second one, it's not going to allow you to. But on this chart, I mean, we have these set up a little bit different. Got the PPO. You can see the scooter. I don't normally have the scooter on my charts, but for this I do. So you can kind of see this one's still sitting up there at 92.9. I can tell you, I'm positive this one will be on our strong ETF chart list next week. I don't know if we'll pick it for the portfolio, but it'll be on that strong ETF chart list. And then you go down here to the bottom and it shows the ETF relative to the S&P 500. So you can just quickly look and see what it's doing relative to the S&P. The whole idea for me anyway is to beat the S&P. So I think it's a great way to at least consider it. But you can go through and then just scroll through all of them. Or you can pull it up in summary form. So you want to see what worked today or what didn't work today. Today, home construction, banking, some of the areas that have been falling apart, we saw them have a little bit of a bounce today, probably a little dead cat bounce, but everything else was getting hit. 4 of our 75 ETFs from 3 months ago, 4 of our 75 went up today. If we look over the last week, you can see a few more went up. If we look over the last 3 months, you can see, even though the market's been really weak, we had some pretty strong ETFs on this chart list and some that fell apart. We'll look at those in just a second. But you can see the metals and mining, natural gas, oil services, small cap energy, oil equipment, oil and gas, energy. I think you're getting the picture. It's mostly energy ETFs that did really well. To the downside, home construction, semiconductors, EV, electric vehicles, banks, regional banking, communication services, consumer discretionary, technology. There's the 3 big sector ETFs. And in the last 3 months, they've been horrible. So I think we did a good job in that we did beat, or at least right now, we're beating the S&P 500. With today's action, I'm guessing we're probably up over the S&P 500 by about 2.5% this quarter. That's pretty good, 2.5 percentage points. Now, I think this is our 5th or 6th month, or 5th or 6th quarter of doing this. And I believe we've kind of split. Like, I think we've beaten, I think this will be the 3rd quarter that we've beaten the S&P, and 3 quarters we've underperformed. We had one really bad quarter, and that's when we had a lot of growth stocks. I think it was last February or last January to April 2021. That's when all of the news started hitting on the inflation after we had already picked our portfolios. And everything changed in the market in terms of what was leading. Everything got flipped on its head. And so we took a pretty big hit in our model ETF portfolio. I think outside of that quarter, though, we may be ahead of the S&P 500. And that's not easy to do when you're doing it with a lot of diversification. You're picking multiple ETFs. I think it's really hard to outperform. It'd be much easier if I just picked one. That unfortunately that would be really volatile, but you just happen to pick the right sector or the right, ETF industry group or whatever, and you might crush the S&P 500 or not. And that's the or not part is the part that you got to be careful about. So anyhow, that's the strong ETF chart list. Very similar to all of our chart lists. We just, have all of this research at the fingertips for all of our members at EarningsBeats. And you can download these, from our website. You can download, it's a link and a password where you can just literally take all of this information, the way we have it set up, and download it right into your stock charts account. Very cool. All right. As far as our model ETF portfolio goes, these are the 10 ETFs that we had in that I showed you on the ETF Analyzer with the percentages. And I also put the percentages in here in the title of the name of each chart within this chart list. So it's very quick and dirty. You can kind of see, okay, DGRW, that was the highest percentage that we put. We had 20% in there. And over the last 3 months, right now, it's down about 3%. And I didn't look to see where the S&P 500 is, but we're probably down a little bit more than that on the S&P right now. Maybe it's a few percentage points more. I'm not sure, maybe 5 or 6. The RSP is down 4%. I would think that the Spider's probably down a little bit more than that. But again, I'd have to verify that. But anyway, you can see it's not like every ETF we picked and every theme worked. If you're picking 10 different themes, I can promise you they're not all going to work. But the whole idea is, just like with our individual stock portfolios, what we're looking for are 1 or 2 to help carry our portfolio. In this case, it was the XME. 10% of our portfolio was in the XME, And over the last 3 months, it's up 31%. So if it's 10% right there, 3% goes right to our bottom line. 10% of 30, which is 3%. That gave us a 3% return for this quarter. So that was, that was good. We had two other winners over the last 3 months, HDV and then Consumer Staples XLP. Winners in a market where the market's been going down. So this is kind of what we were looking at trying to do: hedge against growth, hedge against those large cap names like the Apples and so forth, because if the market was rolling over, back in December, I posted, I thought the market was going to be very weak. It's going to start off the year pretty weak. And so when we put this together on January 19th, that was kind of the theme that we were looking at. We wanted to do some hedging. If growth stocks had a great quarter, we would have lagged. There's no doubt about it. I mean, we just don't have enough growth in here. I showed you our technology weighting was only 14% versus 29% in the S&P 500. If the S&P 500 took off and technology led us higher, there was no way we were going to be able to keep up with the S&P. That's one of the risks that you run. Whatever calls you make, if the market decides it's going the other direction, then you're going to suffer from it. But if if we do continue with high volatility and weakness in the market and the growth stocks lag, then this kind of a portfolio helps. Having real estate helps, having consumer staples, mining and metals. Those, like I said, those areas were very helpful. And earlier I mentioned the HDV, nice relative performer. It was the second best one that we owned. Now, again, did we hit it on every one? No, banks have been very hard, especially the last couple of weeks. I mean, it's just been awful in the banks, but they were up a little bit today. So if we just wanted to see, this was over the last 3 months, but if we just wanted to see what today, how we did, the S&P 500 was down, what was it, one? Well, I can tell you for 1 second what it was down. The S&P 500 was down 1.69%. We only had one ETF in the model ETF portfolio that did worse. I think today we had a really good day, relative to the S&P 500. So we were about 2 percentage points above, a little bit more than 2 percentage points above the S&P going into today. So with today's action, I'm guessing we probably had a relatively flat day overall. Maybe we were down just a little, and the S&P was down 1.69%. So we probably are up about 3.5 percentage points right now for this quarter. And if the S&P is weak over the next week or so, we might be able to widen that. Who knows, over the next week. All right, so that's enough for last quarter and kind of helps to explain what we do here. So what themes kind of make sense, or what should we be even thinking about and considering if you're putting together a portfolio? What are some of the, the bright spots? Where are some of the bright spots in the market? Where are some of the areas you just want to be away, stay away from, that sort of thing? Well, I want to just mention I want to mention several charts. So let's start off first with, and I always start almost every one of my webinars with this chart. It's a 100-year monthly chart of the S&P 500. I've been talking a lot recently about, I think the market's going to be weak, and I've been calling for a bear market, a cyclical bear market. Don't lose sight of the long-term picture, which is we are in a secular bull market, a long-term bull market. Look at what's gone on so far in 2021. Right now on a 100-year monthly chart, this is a blip on the radar, what we're seeing. It may seem like it's really bad and that at times over the last couple of months, it's been horrible. But when you step outside the box and you look at this 100-year chart, you realize how insignificant these moves are from a long-term investing perspective. We're still in a really big uptrend. This was the pandemic where we lost 35% in 4 weeks or 5 weeks. Even that looks a little bit like a blip on the radar. This was the 1987 market crash. It's just a blip in this uptrend. So whatever we experience here over the next couple of months, maybe even 6 months, I want you to understand, from my perspective, it's all part of this uptrend. I think we're going higher later this year. I think we're going a lot higher over the next several years. I mean, a lot higher. Like S&P 500 might be 4,400 now. I think within a decade, it's going to be 12 to 15,000. And you might say that's crazy. Well, if you work it out, it's probably like 10% a year on average, maybe a little bit higher. It's not really that crazy. The S&P 500 has averaged 9% over the last 100 years. Well, definitely since 1950. I've done the calculation since 1950. So if we're looking for the S&P 500 over the next 10 years to average maybe even 12 or 14% in a secular bull market, that's not out of line. And if you want to know how you get to 12 or 15,000, just do the math. It'll take you there. So I just want to make sure that everyone understands from a long-term perspective, I'm still really bullish the market. This, whatever we are going through right now, the recession, this is all going to pass. While we're in it, it feels like the worst thing ever. It feels like sometimes when we have down days like today, or like we had back in January or February, we get in these big moves down, the volatility spikes. It seems like we're heading for a recession and maybe even the Great Depression. And don't flip on, your TV and check in with the local news, or don't go to media on the internet, because I can promise you what they're going to tell you, that you are heading for the Great Depression. And so you might as well just buckle up and just realize you're not going to have any money left after this. That's what they want to sell you. They want you to click on their articles. They want to scare the bejesus out of you. So you'll click on their article and read about how bad things are. I want you to look at this chart and tell me, okay, exactly how bad are things right now? Because I feel like we're in one of these moves to the upside, very similar to the 1980s and 90s, very similar to the 50s and 60s, and they tend to go on for about 20 years. We're about 9 years in. So I think we got another decade of this uptrend with pullbacks along the way, with the possibility of a 1987 crash or a 2020 pandemic along the way. We can't avoid that. It's going to happen. In the 1960s, I think there were 3 different recessions. And yet we were in a secular bull market. Recession doesn't mean secular bear market. Recession sometimes means cyclical bear market. But usually the bear markets are very short term and so forth. So anyway, I just, like to draw everyone to this, this chart just from a long-term perspective. Keep this in mind when you read those articles on the internet. When you start paying attention to the media, just in the background, have this chart in hand. All right, I'm enough. I could keep going, but I'm not going to. So what else? What should we be paying attention to right now? Well, this was a relative rotation graph, a graph that I put in my Chart Watchers article over the weekend. Very quick and dirty. Just explains, this is a 1-year weekly chart, and all of the sectors. I mean, this is really brilliant. Julius DeKempenaar founded RRG Charts. I think that Julius is brilliant for coming up with this. And I mean, if you look at this, all it's doing you is just telling you where you are versus the S&P 500 with each of these charts. And, you can take this thing back and you can literally just watch the rotation that takes place, which is pretty cool. Some of the groups, some of these, this was back in this would have been back in the 12-week period from, it ended October 25th of last year. So when we got to November, this is when things started to really begin to change. You can see the XLY, you see the consumer discretionary leading. This was back 12 weeks ending November 22nd. From that point forward, and look at when the S&P 500 put in its high at the end of the year. Watch the XLY, watch the XLK as we're getting to the end of the year. I want you to watch these two lines right here, this one and this one. And actually I can click on the here. We'll focus on this one first. As we were setting that new high, look at the money rotating out of consumer discretionary and look at the acceleration to the downside as it was starting before the weakness began in 2022. And if I do the XLK, go back to November, here's the XLK, it's back into leading. Everything looks pretty good. There's the end of the year. We're still pretty good there, right? Look how fast, by the time we got to January 18th, this is what we had when I did the Model ETF portfolio. This is what we were looking at. Look at consumer staples. Look at what's happening. Consumer staples, you want to know why we put a specific investment into the XLP? I don't know how I could explain it any better than this chart. The XLP was exploding versus the S&P 500. And with all the signals I was getting, I was looking for the XLP to continue to outperform. And look at what it's been doing. Now, it's still way over on the right-hand side of the chart. So its relative strength is still very, very strong. When you come down here to the middle or anything, coming down is more momentum. This is the momentum axis over here. This is the relative strength. So anything on the right side of this vertical line is excellent relative strength. Anything up above this horizontal line is excellent momentum. So when you get over into this northeast quadrant over here, you have the best of both worlds. You have relative strength and you have momentum. A lot of times really healthy groups will come into weakening and then simply turn right back around and go back into leading again. And that might be, what we see. XLP goes through a little bit of profit taking and then right back up to the new high. But right now, this is where we're sitting. Look at utilities. This is where we are. This is what's going on in the market right now. Healthcare, all the green is right here. You click on them and you can see the rotation that's been taking place over the last 12 weeks. Now, discretionary in the lagging, and we haven't even started to turn back to the right. We're actually consumer discretionary starting to move left again. Look at technology. It's making a left-hand turn. It's going the wrong way. So even with that Max Payne related gain that we saw last month, option expiration week, we saw the momentum start to pick up a little bit on the XLK. And once that period was over, now the group's moving straight left again. This is not what we want to see. And honestly, this is why I'm worried about the market right now. Wall Street is not moving back into the areas where they need to be moving into to make me feel better about a bottom being in or approaching. So if this continues, we could very well go back down and take out the low we saw in February. I mean, we'll have to just keep watching it. But as I pointed out to members in my daily market report, I think on Friday, when the S&P 500 couldn't get back through gap resistance, I said 45.25 was the key. One way to play it was to jump in on the SDS, which was an inverse 2 times juiced ETF. Now that has nothing to do with the model ETF portfolio. We don't include leveraged or juiced ETFs. I'm just saying, we try to help our members with trading opportunities from time to time. And I said, hey, if the S&P 500 is rolling over here, and it looked to me like it was, the SDS is a great way to play the trend to the downside. So when the S&P 500, by the way, went down 1.69% today, look at what the SDS did. It gained 3.44%. So anybody who jumped in last week on the SDS had a big gain today while the market took a big hit. So, technicals are pretty important. Following the lead of this relative rotation graph and what's going on with defensive stocks versus aggressive stocks, all of this matters. Really, really important stuff. All right, let's keep moving on here. Some other things to think about as we put together. I already talked about that a little bit. Oh, but I did want to show you inflation. So inflation is going to be coming out. We're going to get a CPI report in the morning and then PPI on Wednesday, next 2 days. But again, in my Chart Watchers article, and if you haven't already done this, you absolutely should. All of my Chart Watcher articles, if you like my articles and the way I approach the market, and again, you don't have to agree with everything I write. Hopefully I just give you some good things to think about. But if you go to my Chart Watchers article and go all the way to the bottom, you can put in your email address and hit subscribe. And the same thing holds true for my Trading Places blog. So if you go into Trading Places and just click on my last article, this was the one I did today, this afternoon, but you can scroll down and put your email address in, hit subscribe. There's no credit card required. It's no charge. They don't do anything with your email address. You're not going to be spammed. All it does is if I publish an article, as soon as I hit the publish button and it goes to stock charts and prints, it also goes immediately to your email. So as soon as I publish an article, it'll show up in your email box. I think that's a pretty cool feature that Stock Charts has. So make sure you take advantage of that. All right, so what's next? Well, let me move over because I had done a couple of charts that I just wanted to show you. And so here's the CPI. And down here at the bottom is a 12-month moving average, or excuse me, 12-month rate of change of the core CPI. And core CPI at Stock Charts you can get by simply typing in $$ CCPI. And if you want to know some other economic information, one thing you can do over here is you can just type in $, and it'll come up with all these different things that you can find. And if you want more results, you just click on it. So there's your core consumer price index right there, $, CCPI. Producer price is CPPI. And if you want, that's core. And if you wanted the just a regular CPI, I think it's just $, CPI, and then $, CCPI, I believe. But I always look at the core, which is CCPI. Anyway, you can go in and look. There's a lot of different, I think there's like Michigan sentiment. Yeah, $, UMC sentiment. You can look at the sentiment, which I think I talked about this morning on my Trading Places live show. That's another pretty cool economic report to follow. I like to put that on a monthly chart and then do a 12-month rate of change. Right now, sentiment's dropped over the last 12 months more than it has over any 12-month period over the last 40 or 50 years, with the exception of 2008 financial crisis and 1990 when we had the Persian Gulf War. So consumer sentiment's been dropping. That's usually a pretty good indication of a recession ahead. So we've got to be thinking about all these different things and the fact that inflation is a problem. Tomorrow's annual number is going to go higher. If we go back over to the information I provided in that Chart Watchers article, tomorrow's reading, I think Wall Street analysts are expecting a 0.5% increase in core CPI. I use 0.6. That was my number. Again, analyst consensus estimate right now is 0.5. We'll see what we come up with. But whatever it is going to replace the number from March of 2021, which was 0.3. So when you get a higher number in March 2022 than you had in March of 2021, guess what happens to the annual number? It goes up, because all it does is it takes the February number, adds the March number from 2022, and subtracts the March number from 2021. So the annual number is going up tomorrow morning, unless we have a big surprise to the downside. And if we do, then that certainly brings into question the whole Fed's 12 interest rate hike fiasco that they're talking about. Listen, anything can happen. I'll be shocked personally if the Fed raises 12 times. I'll be shocked if the Fed raises 4 times, maybe even 3 times. One's already in the bag. We've already seen it. The next one's probably going to be 50 basis points just to send a message to the market. Beyond that, let's just see, because I think what's going to happen is that your April, May, and June of 2022 readings If they just simply come out in this 0.5 area, guess what? Our annual inflation rate is going to start trekking lower. April is going to be removed at 0.85, then May at 0.75, and then June at 0.80. These three are going to be gone and replaced by lower readings the next 3 months, most likely. That will reduce the annual inflation rate. I could see it falling back to maybe 5.25% to 5.5%, possibly. What's the media going to write about? It won't be the dropping inflation, I can tell you. Instead, it's going to be the recession. That's what's coming next. And that's all we keep doing is just going, from one topic to another, one bearish topic to try and scare everyone to another one. And recession's coming next. I've been saying recession's coming for the last probably 3 months. So just get ready for it. What else do we have to consider? I'm just about ready to wrap up, by the way, just a few more things. How about the sentiment? I cannot believe, and let me see if I can find this chart for you. I think this was a chart that I had at the Market Vision event. Here it is. All right, so here is the 10-year S&P 500 chart. And down here at the bottom is a 5-day moving average of the equity-only put-call ratio. Now, when we got to the top here, one of the reasons why the market really badly needed to come down for a while, there was a lot of different signals that suggested we were going to be weak. But this is one that was screaming for a market top. Coming out of the pandemic, we had a whole new set of investors that, through stay at home, being off from work for a while, that started investing in the market. And it was really easy to make money the last 2 years because everything was going up, especially a lot of the growth names, a lot of the highly aggressive names. We had the short squeeze. We had the Reddit folks, the meme stocks, GME. Just pick something, throw a dart, and a lot of them went higher. As a result, look at what the options world turned into. It just turned into a bullish frenzy with everybody buying call options. The 5-day moving average stayed below 0.55 for 9 months. The 5-day moving average never went above 0.55. Previously, any kind of a move to 0.55 was kind of a top. We lived there for 9 months. And yet, when we look at bottoms, look at where all the major bottoms have formed over the last 12 years. Every single significant bottom came with the 5-day moving average of the put call ratio over 0.80. Every one of them. When we bottomed in February, we got up to 0.7. We never even made it to 0.8. So it was starting, that selling was starting to help our sentiment. But look where we are again. Just 4 or 6 weeks later, we're back down to 0.55 again. It's like nothing even happened. We had one little rally in the market and everybody's like, oh, everything's good to go again. Let's just start jumping back into options, call options. This is a problem for the market. And it's why I think we could run into more problems over the next few months. We need to get the pessimism built up. And you don't do that with the market going higher. The only way you build pessimism and change the entire psyche of the market is by having an extended period of weakness, not a month and a half. We might need to see some consolidation throughout the summer to get this, maybe even more selling, maybe not just consolidation. Maybe we do need more selling. That's just to help us reset sentiment back to where it needs to go. If we can ever get to the point where we see that 5-day moving average of the put call ratio get up to 0.8, it's probably going to be the result of a pretty big drop on the S&P back down into the 3,000 somewhere would be my guess. Now I'm kind of on a fence. I've been teetering back and forth on whether or not I think the February low holds. First time we hit it, I was like, okay, probably about a 70% chance we're going to go back down below that low. And then we had such a strong rally. I wasn't overly impressed by the rally with options expiring, because I think a lot of that was manipulation. I mean, if you look and see what led that rally, it was all the areas that needed to for options: technology, consumer discretionary, and communication services. That's what led that rally. Once options expired, we started seeing weakness again in those three areas. So I think we were highly manipulated in March because of options expiration. This move to the upside went a little bit beyond that 1 week though, and we got back through some key levels. And so I'm thinking, okay, well, maybe that means the February bottom is in. So at this point, I think it's more like, I'm going to say 50-50, maybe I give the bulls a slight edge, maybe 55-45 that February low holds. But I still think, close to 50% chance we're going to go back below that level. Now, do we go to 3,500 or 3,800? I'd maybe put those odds at 20-25%, but I do still think it's possible. Let's just see how this unfolds. I said at the beginning of the year, this was going to be a marathon. This was going to require patience. I mean, I'd like to see the market just everything reset and be back to normal in 6 weeks, but that's not usually how the market works. We've got to go through a period to reset. Look at what we did back in 2014. We had 3 readings under 0.55. Market kept going up, up, up. It took us over a year of sideways action and selling to get the options world to start believing that we'll never go back up again. And then once we got to that point, the market took off again. That's the way sentiment works. So sentiment's a big part of this as we go forward. Because sentiment is still so low, that makes me very hesitant to want to build positions in areas like technology and consumer discretionary. I just think the risks are too high. It's not they can't go higher. Everything in the market's about evaluating risk and deciding how much risk you're willing to take. I mean, it's always easy after the 3 months is over to look back and say, wow, I should have invested in these things. My gosh, that was a really bad call, or this was a good call. It's easy after it's over. It's really hard when you have to try and forecast it. And that's, where we are. So you have to decide right now, how much risk am I willing to take? Do I want to be risky? Am I seeing the signs that tell me to really go heavy into technology and consumer discretionary? I can tell you, if we go down to 3,500, you're going to regret going into technology and consumer discretionary. You might think, well, these groups and these stocks have been so beaten up, there's no way they can go lower. Let me tell you, when we get into a rough period of the market, it can always go lower. So don't fall into that trap, because that's a trap. You see a stock, it's a psychological thing. You see a stock that's trading at $100 and been going up for a few years. And then when it gets down to 70, you think, my gosh, what a great value. It used to be 100. Now it's 70. It can't possibly go below 70. And so you jump in. You don't exercise patience. Next thing you know, you're at 60. And then you're like, oh, well, I'm going all in now because the market's wrong. I'm right. And the market's wrong. I'm going all in at 60. And then it's 45. And, you've taken huge risks and you're getting clobbered. Got to be careful. So I just think as we go into the summer months, which historically are not as good as the other months, I don't believe in the go away in May theory. I think there's a lot of problems with that theory in general, but you can't dispute history. May to October does not perform as well as November to April. That is factual since 1950. And the numbers aren't even close, really. But it doesn't mean you just pack up and go away for 6 months. I think July to September, middle of July to the end of September is really the go away period if you want to focus in on it. But that's a topic for another session. Right now, we're focused on April 19th through July 19th. And I can tell you healthcare tends to do really well over the next 3 months historically. So that's an area that we might want to consider. I did a chart. I think it was in the EB Digest, but let's pull up the medical equipment group. So this is one group, had a hard day today, rough day today, but let's just look at it on a seasonal perspective. And the last 10 years in this bull market, what I'm going to do, actually, let's do this first. Let's just show you the absolute returns, the average historical returns of this group throughout every calendar month over the last 10 years. You probably don't really notice anything, right? Just kind of some months are a little better than others, but for the most part, you know, you're coming across here looking at average returns. It's not really that big of a deal. I want you to look at it relative to the S&P 500 though, and tell me what you see over 10 years. Do you notice any differences? Do you notice where medical equipment tends to really do well historically relative to the S&P 500? May, June, and July. That's the period we're looking at coming up. Our draft is going to start April 19th through July 19th. So medical equipment might be something we're interested in. You know, XLV overall versus the S&P 500 over the last 10 years. May's pretty good. It averages outperforming the S&P 500 by 0.7%. June, 0.5%. July, 0.9%. These are this is the three best consecutive calendar month period for relative performance of the XLV. That might be noteworthy, especially if we happen to pull up the XLV and notice that it just broke out to a 52-week high, all-time high. It was rough today, but this is a group that's clearly outperforming the S&P 500. That might be a theme worthwhile going into the next quarter, don't you think? All right, just maybe one more item. Let me see what else we can talk about here. Oh, just one other thing about the market, and then I'll close this thing down. We can get on with our evening activities, whatever it is we want to do. Where did I put this? Oh, it's in my other account. Well, I'll just show you. If we get a hourly chart, I'll just go back the last 3 months, and we do the S&P 500. Did you notice today? This was in the daily market report that I sent out to members today. And by the way, if you're a member at EarningsBeats, you get a daily market report every day. I'm always sharing my thoughts about the market. So every day the market's open, I will do it. There might be a day here or there. I might do a vacation once in a while where I don't put one out, but for the most part, it's every day. But look at the head and shoulder. Here was the move up. So here's your uptrend. Got to have an uptrend before you have a head and shoulder reversing pattern. I see a lot of people draw head and shoulders patterns and there's no trend. There's no uptrend before it. It's like, how can you have a reversing pattern if you have no trend? Anyway, here we have a clear trend to the upside. Get to this top here at 45.25. Come back down 44.55. Go up to a new high. Left shoulder, neckline, head. Come back down to 44.50, which is slightly below that 44.55 high. So we have a slight downtrend here at the neckline. And then we bounce one more time. Guess where? 45.25, almost right to a T. It's a really nice symmetrical head and shoulder topping pattern. And look what happened today. We broke down and we sold off heavy into the close. Never a good sign. I mean, I would expect that tomorrow we're going to have another down day. We could be up in the morning, but even morning strength would probably be a head fake. And with the CPI coming out tomorrow, I have no idea what we're going to get. We could have a big gap down. I mean, what's going to happen if the CPI tomorrow comes out and instead of 0.5 or 0.6, what if it's 1.0? And it just blows away estimates. You can imagine what the media is going to do and the frenzy the media is going to have with that. So beware, because now, even if, let's say the number is decent tomorrow and the S&P rebounds in the morning is up 30 points, what are you going to do with that? I mean, to me, it'd be a sell. I would sell into it. And I think I would be very surprised if at any point tomorrow we take out the high that from the S&P 500 from today. And when I talked about the SDS and trading that based on the fact I thought the spider was going to go lower, the SDS, as long as the S&P 500 keeps dropping and putting in a lower high, just hold on to the SDS. I wouldn't do anything. Go golfing. You know, just make sure you put a stop in on the SDS. You can, you know, For the SDS, you could put a stop in at the prior day's low. That should be very close to the prior day's high on the S&P 500, right? Because they're inverse one another. So just every day, just put the low in. And if the market keeps selling off, you just keep making money. And if the market reverses one day, your disciplined approach just takes you out of the trade. At this point, you can't lose any money on that trade unless we somehow have a huge gap up. I mean, that's always the case if you hold anything overnight. But barring a massive a gap higher, at this point, the SDS, if you took a position on Friday, you can't lose. Just let the market do what it's going to do. All right, that's basically it. I had a couple other things, but we can talk about that some more next week when we do the event. I didn't really want this to go up much more than an hour. John, if we have some questions, I'll be happy to take those.
Okay. Hi, Tom. Is it possible that we start a long consolidation period like 68 to 80?
No, I don't believe so. Again, you just go back to that chart that I showed before, which if I pull this one up, it should be the first chart. Yeah, here we go. Yeah, I mean, 68 to 80, 2000 to 2012, these are secular bear markets. And we'll have another one. I just don't think it's now. I mean, if you believe it's now, then, that's fine. Everybody's entitled to their own opinion. I just don't believe that's the case. I think interest rates, I don't believe we're going to see a secular bear market start with interest rates at 2%, 2.5%, or 2.7%, or even 3 or 4%. This is what we went through in the 1960s, by the way. In the 1960s, interest rates were going up, but they were going up from historic lows. I think we're going to see that. It's actually good for interest rates to go up for the right reasons. Right now, they're going up for the wrong reasons. Once we get beyond this inflation scare, and I don't believe this is going to last. Again, if you want to disagree. My reasoning is that the pandemic had created a lot of this. It created, after we came out of the pandemic and we started getting more and more people getting out and about and, doing more things, more travel, the demand was unbelievable. I mean, very, very strong demand. We had a GDP reading that came in over 7% or 8% or whatever it was. That's crazy high. So you got this tremendous demand. And then on the flip side, you've got supply chain issues because of the pandemic. So the whole demand supply thing is out of kilter and has been for the last year. What I think is going to happen is the Fed, by raising rates and threatening to raise more, is going to curb consumer spending. We're already seeing consumer sentiment dropping. Over the last year, it's been crazy. If we have a recession, guess what happens to demand? It falls right off a cliff. Where's inflation coming from? If all of a sudden we start catching up on the supply chain issues and demand falls back through the roof, there's going to be no inflation. The Fed is going to not follow through with all of their rate hikes that they're talking about. And guess what's going to happen to the bond market? Everybody's going to want to buy it, sending yields back down. And when yields come down, guess what's going to happen to growth stocks? While we're in the middle of a recession, the growth stocks are going to take off. I mean, it's happened. Go back and study 1990 with the Persian Gulf War. I mean, it's similar, everything except the pandemic. We had the 1987 market crash, which maybe was somewhat similar, but not pandemic related. But 1990 to 91 is probably the best historic comparison I can make to what we're going through right now. And what's ironic is 1990 and 91, if you look right here, was right in the middle of a 20-year secular bull market, right where we are right now, ironically, right in the middle of what could be a 20-year secular bull market. So no, I don't believe we're going through what we saw in 68 to 80 or 2000 to 2012. I don't expect one of these 12-year periods. I have said, been on record many, many times over the last, I can't even tell you how many years, that we are in a secular bull market. Every time that folks want to challenge this bull market, they're wrong. They are wrong every time. This is a secular bull market. Use it to your advantage. And that, again, is just my opinion.
All right, I could have answered this one for you, but I'll let you answer it. If you're in your own account, being you, Do you use ETFs or individual stocks or both?
Well, I use both. When we're in a bull, when we're trending higher in a secular bull market, I'm in individual stocks. Absolutely. And these percentages that you see right here on this chart, this is how all of these different ETFs, the sector ETFs, the NASDAQ, and the S&P 500, this is how all of them have performed since April 10th, 2013. And the significance of that date is right here when we broke out of this red shaded area and we cleared the tops. You know, some people say the bull market started in 2009. I mean, yeah, with hindsight, once you get to 2013, you can say that, but you don't know that you're breaking out until you actually do in April. Here, was this a bull market coming back up to test this prior high? I mean, did the bull market start in 2003 and it was just going to keep, oh, wait, no, we went back down to a new low. Well, why couldn't the same thing have happened in 2013? It wasn't until we got this breakout that we confirmed a secular bull market. Just like here, it doesn't, until we take out that prior high, it doesn't confirm. So I think that was the breakout, even though we did have a rough 81 and 82. I think this confirmed, and I still treat all of this as part of the secular bull market, even though we gave back some of our early gains. But that started this 20-year move. This breakout above this double top, I mean, 1929, 1930, that was kind of a different ball game altogether. So I was looking at the two reaction highs here and figured once we made that breakout, and that happened to be a 20-year bull market, by the way, which is kind of similar to what we have historically seen. So I just think we're in this grand super cycle, or whatever you want to call it, where stocks are in favor. And they should be with interest rates as low as they are right now. Where are you putting your money? I mean, back here, when we did all of this, you could have made a lot of money in the bond market. You could have made a lot of money in energy. You could have made a lot of money in materials, in gold. There were other places to go. Where are you going to go right now with interest rates at 2.5%, 2.75%, whatever? I think you're going to see investors pouring back in. We just have to get through this short-term issue. Now, as far as the ETFs go, we do this for our members. You know, we have a lot of members at EarningsBeats, and we get members who don't like to trade individual stocks. And so we get emails, you know, what can you do something for us ETF investors? You know, I like your approach. I like what you do, but I'm not going to buy individual stocks. So what can you do to help us? And that's how the Model ETF was born. It's for folks who don't want to trade individual stocks. Now, I do not invest in the Model ETF portfolio. If that bothers you, that's fine. I'm not an ETF person. To me, ETFs are akin to diversification. And I don't like to diversify. Warren Buffett has said over the years, diversification is for those who are ignorant. If you don't know not that he wasn't saying it in a bad way. He was just saying that if you don't know what you're doing in the stock market, then by all means diversify and invest. Be invested. That was his point. But he doesn't diversify. He makes huge bets in individual companies. He had so much money in Apple. Was that diversification? No, it wasn't. Warren Buffett is one of the most aggressive traders of our time. Yet everybody kind of thinks he's, you know, this meek little conservative investor. He's not. He's aggressive. He just happens to be really good at it. And when the market's weak, he takes advantage of it. And that's what I'm saying about 2022. If we're weak throughout this year, be licking your chops. Be ready to take advantage of it. Don't fret it. That's the way I approach it. And whether you're in cash, you know, the ETFs, when I said I invest in ETFs, when we get into a market like this, and I believe the market is going to go lower, like I was talking about last week, I get into the juiced ETFs, the inverse ETFs. I own the SDS right now. I was a little, you know, I could have done the QID. To me, the SDS was a little bit more conservative approach to shorting the overall market. So I did the SDS instead of the QID. Normally, a lot of times I'll do the QID because that's a more aggressive way of shorting the NASDAQ 100 at a 2-to-1 clip. But so I do trade ETFs. And like I said, I'm in one right now. It's just not a model ETF. That's not my style. The model ETF portfolio is more for folks who just simply want to look at the ETFs, not interested in juiced and leveraged ETFs, and just want to follow this bull market for the next 10 years using ETFs as opposed to individual stocks. That's the whole idea behind it. Another long answer to a short question.
Okay, I think we wrap it up right now. Remind everybody you'll get a copy of the recording. Also, tomorrow night, listen, if you're just in here and you're not a subscribing member or don't have a trial, consider taking out a free trial, because the Options Max Pain webinars is very insightful. It gives you a good idea of what to look at in the short term. And we've got a couple of other events coming up for members only the next couple of weeks. So a great time to really come in for no cost. And hopefully some of you will take us up on that, right, Tom?
Yeah, I mean, we work really hard. I think our members that have been with us for a while know the amount of information that we put out. If you want to make more informed decisions in the market, you want to learn more about the market. I mean, that's the other thing is I wouldn't just look at our service as a service, where, if you make money, it's a great service. If you lose money, it's not a great service. I think a lot of what we do is more about guidance and education. I mean, obviously trading as well, but we do a lot in terms of educating our members and the general public. To be honest, we do a lot of these free events, which I think, provides the community a lot of pretty solid education as well. Our EB Digest 3 times a week coming out for free to help educate. So, I mean, our service is more than just, trade this or trade that. And I think members that have been with us for a while know that. But yeah, we'd love to have you. We do offer annual memberships where you can get quite a discount off the monthly rate. So if you do try us for 30 days and you're interested in extending, don't just let it roll over to the 147 a month, because we can give you a much better deal. We have annual rates for $9.97. And normally when you sign up, we'll give you an extra bonus month, 13th month for $9.97. Do the math. That's probably about half of that 147 a month. So there are some cheaper alternatives as well. Anyway, that's it. I really appreciate everybody tuning in and joining us tonight. I hope you found this informative. And I hope if you're not a member, you'll think about becoming one. Have a great night, everybody. Happy trading.